In simple terms, if your company controls another company, you may need to combine their financials and report them as one. If you own more than one company in Singapore, there's a rule that could quietly cost you your audit exemption, and many business owners don't even know about it. It's called consolidation. And control isn't just about owning more than half the shares. Even owning 45% can count, especially if the rest of the shares are spread out and no one else is actively involved. Here's where many groups get caught off guard. Skipping consolidation might seem easier, but it can actually cost you your audit exemption. To qualify, your group needs to stay within these limits: 10 million Singapore dollars in revenue, 10 million in total assets, and 50 employees. You only need to meet 2 out of the 3. If you don't combine your numbers properly, the authorities may look at each company's figures together without removing internal transactions. So even if your real combined revenue is 7 million, it could appear as 12 million on paper. And that could push your group into a required audit. That said, not every company needs to do this. There are some exceptions. For example, certain holding companies, investment companies, and dormant companies with very low assets. Also, this only affects how you prepare your accounts. For tax, each company is still treated separately in Singapore. There's no group tax filing. However, your company structure still matters. You may be able to share losses between companies in your group, but only if they are properly linked within Singapore. If the structure goes through an overseas company, that benefit may no longer apply. Getting this wrong can be costly to fix later. If you're running a group structure in Singapore, it's worth having your setup reviewed properly. Need an expert's touch on your consolidation? Reach out to Corporate Services Singapore anytime.